All right, today, ladies and gentlemen, we have Jess. Words, I'm messing up already. Jeff, I was focused on the last name.
Perfect.
I know, right? Today we got Jeff Neumeister. I said that right?
Yeah.
Okay, cool. A well-educated, experienced forensic expert and consultant in accounting and financial advisory services. Small organization setups, holding entities, small networked individuals, and middle market companies have relied on Jeff's mitigated taxes, identity problems, uncovering fraud, and a ton more. The brother does it all. So we want to welcome you, Jeff. Thank you so much for joining us.
Thank you for having me.
Thank you, Jeff. So you're a forensic accountant?
Yes.
Yes?
Yeah.
Okay. So I was telling Jeff. First time I ever heard the word forensic accountant, it was some celebrity that was getting divorced and the wife hired a forensic accountant to dig into the finances of the husband because she felt like he was hiding some money. And lo and behold.
People usually are.
Okay.
See?
Okay.
So how often do you
Well,
run
hold on.
into...
Before we do that, break down in a couple of sentences what you do, if you don't mind.
Sure. Say that we help our clients navigate the complex waters of finance and accounting issues, period, the end. And we do that whether it's helping them file their taxes, investigating a fraud, help them calculate damages if someone breached a contract with them, anything to do with accounting and finance.
Okay. Really quick, two-part question. The best part about your job, the worst part.
I think the best part about the job is kind of putting together the puzzle with some complex situations.
Okay.
I get some sort of sense of fulfillment out of that. I think all accountants to some degree do. You have to, or else why are you in accounting? The opportunity to help put people's minds to ease, knowing that if that's not their forte, accounting and finance, that they can rely on a trusted person to help them figure that stuff out.
Okay.
And the worst part?
I think the worst part is I think owning a firm, just that managing the stresses that come with that, managing staff, bringing on clients, it's a lot sometimes.
Okay. Well, something like the best part is the job. The worst part is managing the job. Managing others to do the job. Okay.
Yeah.
All right, cool.
Okay, so back to my question. So how often do you find that, people hide money from one another when you're dealing with forensic?
Yeah, I would say in almost every single case where we've been engaged to do some sort of forensic thing, there's something going on, something fishy. People hide money, people use money to buy blow, people buy money to have extramarital affairs, whatever it is. Right? People are doing shady stuff all the time.
How often do you run into that sort of thing?
Almost every single time we're engaged for a forensic case,
and
we find stuff.
How often do you find yourself engaged in a forensic case?
We usually probably have 12 to 20 cases a year. On top of like our regular, taxes and bookkeeping and consulting work.
Yeah. Okay.
That's crazy.
Every time. Okay. So what that tells me is that if there is a suspicion, there's probably something there.
It's usually founded on something.
Okay.
Yeah.
Okay. Interesting.
Okay. So we're gonna get into sort of like dealing more with married couples. So are there any benefits to a married couple filing separately at all?
Usually not tax-wise.
Right. Okay.
There's caveats to all this stuff. We're not going to spend a lot of time digging into the Internal Revenue Code.
Right.
Okay. There's exceptions to everything, but generally speaking, I would say no.
Okay.
Usually the only time I usually recommend that people file separately is usually because it's a contentious divorce and they just don't want to deal with one another.
Oh.
So in that case, it has nothing to do with taxes. It's all about the personality conflict and not just wanting to have to negotiate and go sign things together, right?
Okay.
If it ends up costing them a little bit more in tax, people are willing to do that.
Just to
avoid having a deal.
Mm-hmm.
Yeah.
Okay.
So why does the IRS usually urge couples to file jointly?
Well, for one, people are more likely to file timely, because now the IRS is expecting one return instead of two.
Okay.
Got it. Okay, so let's work for them.
Right, it's quicker to process. Now all the income is on one return instead of split up between two.
Are there any downsides to filing jointly at all, or is it just?
In community property states like California, not really, because even if you file separately, you each have to split your income in half, and the other person, it goes on to the other person's return.
Gotcha.
Right. So in places like California, I think there's another like half dozen or so states that are community property. There's really going to be no difference tax wise.
Got it. Okay.
Okay.
All right. This is one from the job. A couple coworkers asked me this. So as far as getting energy efficient cars or appliances, how do you go about writing those off, and like what's the benefits of getting energy efficient?
The benefit really is federal tax credits.
Okay.
So for example, for 2019, if you got solar on your home, you got a 30% tax credit, right? Which could be a big number. Right?
When you say solar, you mean solar panels?
Solar panels,
Okay.
right. So if someone spent easily 15 grand on their home for solar, 30%, that'd be 4,500 back on taxes. Right?
Okay. Nice. And then going with solar panels, that cuts down on because everything is electric at that, or
It kind of offsets some of the normal electric usage you would have from the the state or the SCE.
right. Okay. Nice.
So, is owing on your taxes always a bad thing? Like, I don't know, every time someone says, oh, I owe this time on my taxes, everybody's like, ooh, it's like, like a very taboo thing.
It's like having corona.
No, actually, I encourage clients to try to see taxes differently.
Really?
Right? If you owe taxes, that means you made money.
Oh.
If I had to send $10 million to the federal government for taxes, that means I made probably $40-50 million. That's it's not a bad thing. Right? So if you think about it, the more you owe in tax, the better you're doing. It's actually an excellent indicator in terms of your net worth.
See, why are we trying to think so differently? Like owing on your taxes is just like the worst, besides an audit that you can possibly do, on your taxes. I guess everybody's just trained to want to get a refund, and
it has a stigma attached with
yeah.
it. I mean, realistically, no one really wants to pay extra money or their hard-earned money on taxes, which we really don't see the immediate benefit from.
Right.
And realistically, I mean, it is paying for infrastructure, our highways, and all these other services that we use all the time.
Is it really, Jeff?
Yes. Yes. I mean, because the money comes from somewhere.
Okay.
And the only place it comes from is taxes.
All right.
Governmental bodies, their entire revenue stream is, almost entirely tax-driven. Sales taxes, payroll taxes, income taxes. Right?
Okay.
But because we're not the one paying the bill directly,
Right.
it feels very detached.
Yeah.
Right? It feels like it just goes somewhere, and we're not really sure if it's used how it should be used.
Right, exactly.
So my personal question to that is, if we pay, because we mentioned it off camera, but you pay taxes every day on everything that you purchase, as long as the sales tax on it. So if I'm paying taxes on something every day, and then I have to pay taxes out of my own person, like how does somebody, or how does the government justify that, or how does the IRS justify that?
You mean the additional tax at tax season time? Well, if you're an employed person, like a W-2 earner, right? So you don't have your own business, then you're paying the federal government all the time anyways.
Right.
Or your employer is withholding your income tax every 2 weeks, every month, whatever it is,
Right.
and paying your tax. So at the end of the year, if you owe, that's just because your employer or the payroll company was not
Didn't take
taking
out
enough money, right?
Got it. Okay.
In fact, one of the tricks of the trade that some tax preparers use is the justification for their costs based upon how much of a refund they get a client. But the reality is the taxes you owe are the taxes you owe, no matter whether you file yourself or have someone else do it. Now, the benefit of having a licensed professional prepare your taxes is that, one, you don't have to deal with it, right?
Right.
Two, they'll probably do it more accurately, so if there's an extra credit or deduction that you might not be aware of, they could take advantage of that. And also that now you're able to hold someone accountable, malpractice insurance, if something is wrong.
So if there's an audit, if I hired somebody to do my taxes and then I get audited, that means that I can hold you accountable, or
Potentially, right? So if a tax preparer or a CPA, they don't necessarily have to be a CPA, they could be an EA, an enrolled agent. If they prepare taxes based upon documents provided by the taxpayer, but the documents were incomplete, that's not their fault.
Okay.
Right? But if they take whatever's provided and they misentered stuff, right, and that resulted in penalties and interest for some reason, yes, they could absolutely be held accountable for that penalties and interest.
Interesting. So how does one prepare for an audit?
Documentation, through and
That's
through.
it.
That's it. The quickest way to make an audit go away is by having clean, accurate documentation that supports the tax return.
Do you need to like hire somebody? Like, say if you did your taxes yourself, right, and then you get audited, would you need to then hire somebody to
Not necessarily.
help you through it? No.
No, not necessarily.
Okay.
I mean, if there's if the auditor indicates that, you know, hey, we believe that you underreported $500,000 in taxes. Well, I mean, it might be, because that's a really big number. It might be worth hiring a CPA and a tax attorney.
Oh, okay.
Right, but if they're just saying, you know, show us the support for these commissions, right, and it's $5,000, well, it's probably not worth hiring someone, given that it's a small number that we're likely dealing with, right? Because you're going to spend $4,000 or $5,000 in professional fees easily.
Right. Okay. So you mentioned, actually, you answered one of our questions, which was, what's the benefit of having, a licensed agent to do your taxes for you? Obviously, they're up to date on all of the new policies, new, I guess, loopholes that are available or things that we may not be aware of. But so let's say somebody does have a W-2, but they also have their own business. How would they go about filing?
So in that case, and we see a lot of that, especially here in LA, because most people
You
have
got that.
most people have multiple things going on.
Yeah.
Right? In the case of a W-2 earner that also has 1099 income, so what you'll do is report the wages, the W-2 underneath the wages section on the 1040, and then since they're receiving 1099 income, right, that's like a personal business.
Right.
Even if you didn't form an entity, it'd go on your Schedule C. Right? And so then, because it's a personal business, they also are given the opportunity, they could take deductions for business expenses.
Got it. Okay. Now, I know the list for business expenses are extensive, but I know one being energy efficient. Well, most people, they have their own business, they get the transportation and write that off on the business.
Oh, I wanted to ask about that. Go ahead.
So let's say somebody got an energy efficient car for their business. How would that go as far as writing it off? Like, do you get more because it's energy efficient car for work?
Not necessarily. So another kind of misconception people have is that they have a business and they decide there and get a car and put it underneath the name of their business.
Right.
Just because you put it underneath the name of the business doesn't mean you can write it off, right? If you're using the vehicle, let's say 10% for the business and 90% personal,
You can't.
you can't do that. You can't take a deduction for 100% if most of it's personal.
Right.
So no matter how you classify the ownership of the vehicle, it's still going to be restricted to just business use. Right? So I usually advise clients, unless they plan on a vehicle being 100% for business use, or at least 90 or something pretty material,
Right.
just that buy it personally, and then have the business reimburse them for the mileage rate, which for last year is 58 cents per mile.
Okay.
There was something I heard, because I feel like I'm going to misquote it, on the Grant Cardone show, where he was talking about leasing a vehicle of a certain, I think it was a weight. It has to be like a certain weight, or it has to be like an SUV. And then you're able to write that off, the lease off. Do you know anything about that, or am I?
You might be referring to like bonus depreciation or something else. There are certain special tax credits out there based upon, you know, types of vehicles.
Right.
Okay.
But again, no matter the type of vehicle, no matter whether you lease or buy, in terms of being deductible for business, it's going to be contingent primarily on how it's used.
Gotcha.
He was okay. It was in real estate, and they were using the vehicle. They purchased or leased a Range Rover, and justified the use of purchasing a Range Rover, saying that they had high-class clients that they needed to shuttle around.
And for someone in the real estate space,
Mm-hmm.
and given how much some of them travel, they might drive 20, 30,000 miles a year
Right.
easily, just for business.
Mm-hmm.
And if their clientele base, let's say that they list homes exclusively in Bel Air, Beverly Hills, those areas, then they have a case, right? If it is challenged by the IRS or the Franchise Tax Board,
Right.
they'd be able to make a case that this vehicle is justified, given that they have to uphold a certain level image,
Mhm.
given their client base,
Mhm.
right? And they could probably support that.
Interesting.
Nice.
Very interesting. Okay. Well, what do you do if you miss a year of filing in?
Filing taxes.
Uh-huh.
Then you
Are you
file.
screwed?
No, you just you come to the table, you file with the taxing authorities, and say I'm sorry, pretty much, right? If they
You have
send
to pay an
notices,
extra penalty or something.
likely there'll probably be some penalties interest. But if you come to the table to them, especially the IRS, they're more inclined to be amenable to any adjustments of penalties interest. If you wait until we've seen this before. Some folks, they don't file for 5-6 years, and then they have all these load notices, liens on their personal bank account, and they're like, "Oh, I needed to deal with this." Now they're in a position where they're not going to be as inclined to negotiate with them,
Because
right?
they
Because they had to
find
chase,
you.
right?
Yeah.
They had to chase those individuals.
Interesting. Okay.
So, how late can you file? Like, what's the count? Like 2 years, 3 years? Like, as far as like back taxes.
As late as necessary.
Okay. And then whatever the penalties are, you just pay the penalties.
Right.
Okay.
Now, the good thing with like the IRS is there's this a get out of jail free card, we call it, called first time penalty abatement. Every U.S. person or every taxpayer is given one of these get out of jail free cards,
Really?
and it's only with the IRS. Some states might have something similar. Franchise Tax Board, for example, here in California, they don't have a similar system in place. You can still try to get something waived, but with the IRS, let's say that they assessed, $50,000 of penalties interest for underpayment, for failing to file, whatever it is. You could play that card and then it'll just go away.
Oh,
The
wow.
taxes won't go away,
Okay.
right? But
okay.
penalties interest can go away.
Okay.
Okay.
But you can only use that card once, right? So some clients, when they're faced with the situation,
Mm-hmm.
and they realize that they have this card, so to say, it's virtual, it's not an actual card.
Right.
I encourage them to maybe hold off if it's a small amount.
Right.
If it's $1,000 of penalty and interest, I will tell them, yes, technically we could probably use that on your behalf now,
Right.
but keep in mind, if you have something later on in life
Right.
and it's a bigger number, you'll wish that you held off on using it.
Mm-hmm.
Right.
Okay.
You
So,
know, the break in case of emergency because you only have one.
Right.
Okay.
so you you do entertainment, or you work with people in entertainment as well. The tax law changed recently for actors. Like actors used to set up holding, are they called holding companies, the
Like loan
LLCs.
companies, holding
Yes.
companies, yeah. 85 changed a lot of that.
So can you talk a little bit about that and what the change was and how it's affecting people in entertainment or?
Sure. Well, first caveat, I'm not a licensed attorney, so some of
Okay.
this kind of delves into the legal realm, but I'll
Okay.
tell you from a CPA standpoint
Okay.
what
Right.
we're seeing. The AB5 that went in effect January 1st of this year essentially made it more difficult in California for people to operate as freelancers, independent contractors. And so what a lot of production companies and other businesses in the entertainment space are doing is, rather than taking the risk that they're paying someone incorrect as an independent contractor, they're saying, you know what, you're just all employees now, right? And that's a safe and conservative approach that we're seeing taken. Is it right? It's kind of split, right?
Right.
There's a justification for some people to still be paid as independent contractors. But in order to do that, you really do have to show that the entity that's set up is truly independent, right? It's not essentially just a name and a bank account, right?
Got it.
For example, if it's an S corp, right? Do you have corporate minutes, right? Do you file your returns on time? Do you have a license? All these things that kind of make it like a very legitimate business.
So we are not, as artists, able to take the same deductions that we were possibly able to take before, correct?
Right, so the downside of being forced into a W-2 box is that the Trump tax laws that went into effect in 2018 got rid of the unreimbursed business expense deduction on Schedule A. So now if an employee is not reimbursed by their employer, then that's just out-of-pocket money. Whereas it used to be they could at least, even if they weren't reimbursed by an employer, they could still get the deduction on their personal taxes. It's not the case anymore. The only way they get that deduction now is to be classified as a freelancer or independent contractor, right? To have your own entity, whether it's Schedule C, a 1065, an S corp, whatever it is, but it needs to be separately stated.
Interesting.
Does that confuse you more?
Yeah, you got a follow up?
No, I had a follow up, but I'm just irritated.
So, let's say as an actor, right? I'm taking acting classes, photo shoots, traveling to sets, things like that. None of that's taken out, right? So I try to file that. I no longer can claim that as a write-off.
If you're receiving 1099 income, right, you might be able to take it against that,
Okay.
especially if you have like an entity set up, right? But the individuals, let's say same thing. Let's say they have classes, wardrobes, like these other typical expenses in the entertainment space, but that all their income is W-2, they're not going to be able to take that.
So when you say all their income is W-2, every gig that they book or project that they work on, they're identified as an employee,
Right?
and they can't.
Because they have no income to take it against.
Gotcha. Interesting. Okay. But what would constitute as a independent gig, I guess?
Really, there's certain criteria to meet the AB5 thresholds. Again, it's more of a legal determination. But if, let's say, all their gigs, they're able to somehow negotiate with the paying party to get paid as a 1099 person rather than W-2, well, now since it's 1099, now you can take that on your Schedule C, right? So now there's a mechanism to take those deductions, so long as they're deductible in the first place. Right? Or even preferably, if they have an entity set up, like an S corp, for example, and they get that income paid to their corporation, not to them personally, it's even a better foundation for taking those deductions.
Gotcha.
Okay.
So instead of putting my name, Saeed Shabazz, on the form, I would put Stronger Together Productions, and it will pay the production company, and then that would pay me from that.
Exactly.
Even
yes.
as a W-2?
No, so
okay, just as a 1099. Okay.
Right, so it'd almost be like they're paying a vendor, right, instead of a person. They're
Right.
paying a company instead of an individual.
When you do it that way, though, do you end up having to pay taxes twice? Because you're paying like taxes when the money goes to the vendor. Aren't you paying taxes on that, and then don't you pay yourself? You get what I'm saying?
That's only in the case of a C corporation. The whole concept of double taxation that a lot of people have heard of, but that's only in regards to a C corporation. S corps, partnerships, LLCs, those are all considered pass-through entities. So in other words, the entity doesn't pay tax, other than possibly some sort of state franchise fee, like the $800 LLC fee here in California. All the income tax is paid by the individual. So whatever the business makes, it just flows to the person.
Okay.
Yeah.
Got it.
Okay, so
So there's no double taxation in that regard.
Good.
because I heard about that too.
Me
that
too.
we're taxed on the total income, the net, and then also on because once I get my check, I just have to pay my manager and my agent 20 and 15% of whatever it breaks down to, and the residual of that is mine. But then I have to pay taxes on that as well. Yeah, we still doing that? Okay.
Right, but that's just on by you individually, not the entity. Right, so if the entity is receiving the income, the entity's not going to pay tax on that, and then you pay the tax on it. It's just you.
So what is the entity going to pay? They don't have to pay Any
You're just paying the annual fee.
Correct.
the annual
Yeah.
the 800.
Yeah,
Okay.
and it varies from state to state. Some states don't have an annual fee. California LLC, it's a minimum of $800.
Mhm.
An S corp, same thing, $800 or 1.5% of the net profit.
Wait, minimum. I thought that was just the total. I thought it was just the flat, like 800. No.
No, I
What?
mean most people are
Okay.
familiar with the 800 LLC fee, but if the LLC, let's say, grosses $5 million, right, it's not going to be $800. It's going to be, I think, $6,800 or so. You have to pay more, a little bit more franchise tax
More you
if you make a lot more. But most people are usually below the threshold, so they end up paying only the
Only
800.
the 800,
Yeah.
because that's all I've ever heard
Yeah.
is that 800. So okay. All right.
What are some of the top write-offs that you see?
Top write-offs for any kind of
For
business
Yeah, just across the board.
across the board. I think the one that's kind of tends to fall through the cracks most often is going to be a business use of home, particularly if you don't have your own office space
Office,
or
right.
rental space.
But doesn't it have to be like within a certain measurement or a certain
Square
amount?
footage.
Yeah.
Not necessarily, but
What
it
is
doesn't
it?
have to be a designated space. You know, so for example, someone can't say my living room is 300 square feet and I use half of it for business. It has to be a designated space that's not used for anything but just business. No mixed use. Like you can't take kitchen 30% of the time for business. So, right, that doesn't go in.
But I rehearse what
Okay,
I could.
So in our case, how would we do that? We have a tiny little studio.
Right.
Seriously. And we work out of there a lot.
Yeah, we do.
So it's like, what would we do? We wouldn't be able to claim it at all.
Not without kind of skirting into the gray area. Maybe I'm not saying absolutely not, but I'm just saying it's not clear cut as is having a designated office that you use just for business,
Just
right?
right.
Yeah.
Well, we do 100% use the dining room table.
That's
as our
right. That's
office.
right. We sure do.
100%. I'll need that
The
table.
dining room table is about as big as
Right.
this.
Okay. What are oh, did you have another one, or is that like the most?
One other thing on the business use home, then like once you know what that space is,
Yeah.
then you take that as a percent of your overall square footage,
Mhm.
and then we apply that against either your rent or mortgage,
Okay.
against your utilities, right? So you come up with that pro rata percentage and we apply it across the board.
Okay. And in order to use that, you have to have your own business, right?
Correct.
Okay. So you can't work at Best Buy and say, "Well, this is my office space." Like, no, your office space is at work, buddy.
Right.
Okay.
Yeah.
You have to have your own. Okay.
Yeah.
Cool. Okay. What is the most common mistake that people make on their taxes?
The most common mistake is
4,000, right?
being compliant and being transparent. The most common mistake is not filing in time, not reporting everything, right? Just being, either
Vague.
setting them to the side, right, or forgetting things, forgetting documents, like those little notices you get in the mail, whether it be 1099-G, 1098, whatever it is, making sure that those are earmarked and set aside and either use yourself for your tax preparation or given to your tax professional to use.
Right. So many documents we have to get together.
I
It's
know.
not even funny.
Here's one. So when you first get married, so let's say somebody gets married in May, right, midway through the year. Is there a benefit on getting married at the beginning of the year versus in the middle, or does that not?
Actually doesn't matter. What's kind of interesting is the way the tax law works is whatever your marital status as of 11:59 p.m. on December 31st, that's how your marital status for the entire year.
Oh, really?
Interesting. Okay.
Right. So if you were married at 11:59 p.m. on December 31st, they say that you were married the entire year. If you were divorced at 11:59, you were divorced the entire year.
Interesting.
Okay. Okay. Cool. That's good
Oh,
to
we
know.
just missed it.
I know. we literally got married January 1st, 2015.
Oh,
Yeah.
well, congratulations.
2018.
2018.
Jeez, man, get the days together.
God.
All right. I had another,
Can domestic partners get any tax
breaks.
breaks?
I believe now that it's legally recognized, I believe it's the same.
Oh, okay.
Yeah, same now.
Oh, okay.
Now, how many years do you have to live with somebody in order for it to be considered domestic, a domestic partnership?
Oh, for like a,
Don't you just have to file it?
I think you just file it,
Yeah.
and it varies from state to state. Like some states have the common law marriage
Yeah,
thing.
common law, yeah.
I think it's some places it's 5 years, some places it's 10 years.
Okay.
It varies. Yeah.
But if it's been 6 months and we decide to file as
Mhm.
common laws,
If it meets the state's requirements and that's how you file, then it'll be recognized.
okay,
Yeah, but I have to check with the state.
got you. Stay busted.
Yeah.
Okay.
Yeah.
That's been good. Thank you so much for everything.
Do you have
I-
anything that you would advise? I'm sorry.
Yeah, go
that
ahead.
you would advise a couple to look into as far as tax breaks or what to prepare for coming into it once you like new couples?
Sure. I think for new couples, actually, because I got married just a couple of years myself.
Oh, really?
Congratulations.
Yeah,
Congratulations.
thank you. Our daughter just turned 1.
Hey,
Aw.
welcome. Part of the club, the winning club.
A little tax deduction.
Right.
Lucky you.
It doesn't offset how much they actually cost.
No.
So you appreciate it.
I would recommend to start thinking far ahead. Right? Start thinking about retirement. Start thinking about where you want to be when retirement comes around.
Mhm.
Right? Take advantage of tax deferral strategies like Roth IRA or traditional IRAs, 401ks,
Right.
personal investments, buying a home. All these kind of things. Our tax code is structured to encourage people to do those things,
Okay.
and we don't see them leveraged as much as they should.
Hmm.
Gotcha. So you would say IRAs and retirements are what people like start planning for that now.
Right. Start looking at buying a place. Start looking at buying a rental place. Investing in retirement. Yeah, all
That's
those
a
things.
goal for us,
Rental
but
property,
we gotta get some things straightened out first.
We're gonna finish your list. What were you saying? Rental and what else?
Yeah, rental property. Yeah, things that will generate passive income for you as a couple.
Okay. Nice. And,
Well, no, I'm good. You've answered all my questions. You've been great.
You've been on fire, man. Thank you.
Thank you
this has
so
been great.
much.
Where can we find you? Where
Yeah.
can people reach out to you if they have any questions or if they want to possibly set up a meeting with you and figure some stuff out?
Sure. Our website is www.neumeister, NEUMEISTER, CPA.com. We're here in Burbank. We have a satellite office downtown LA, another one in Simi Valley, and also Chicago.
Oh, wow.
Okay.
Okay.
Welcome to email us, call us, come by and see us anytime.
Awesome. All right, guys, you heard it here. We'll definitely be talking with you more
Yes,
for sure.
we have a meeting.
You gave a lot of great information and you gave some stuff to think about as well.
Awesome.
Thank you so much.
Thank you so much,
Thank you,
Jeff.
guys. Thank you.
Bye.
Well,